Another day in this very strange market. However, today I felt like things were getting a little bit less strange. We obviously talked about yesterday some divergences we were seeing, particularly the Microsoft Google divergence, the top level of FANG versus the bottom rung, in my opinion, of FANG. And that is continuing to play out today to some extent. We saw Google strong for a lot of the day, Microsoft weak basically for the whole day from the peak in the very early morning. And I think this is going to continue in the sense that it's the sign of peak mega cap tech. Let's not forget, we're roughly at the same levels that we were at the all-time highs, but earnings growth has declined dramatically. And it's not like this is 1 or 2 quarters we're expecting this to be a case. We're expecting this to be the case for like 1 or 2 years at least kind of situation. This is a big deal, particularly when interest rates are higher. Why are you going to take the same amount, if not more risk, buying these stocks when the risk-free rate of return has gone up? And let's not forget, a lot of the people buying these tech stocks are not necessarily people looking for a 50% return per year. These are people looking for a safe harbor. And at that peak, during coronavirus, there was a TINA trade. What does TINA mean? It means there is no alternative. Why was there no alternative? Because treasuries were yielding so low. There simply was no return, and they were printing money. The important factor is, before considering growth rate, before considering the economy, the important factor is interest rates have gone up, and there is an alternative. Then you take a look at the stock price, and you take a look at the earnings, and you take a look at the growth, and then you take a look at the earnings multiple, and you realize when these stocks have these kinds of growth rates, they don't have these kinds of multiples. Everyone makes a right assumption. Microsoft, Apple, these companies are good companies. They make good products. That is the correct assumption. That is the observation that is very clear and shared by everyone. And I don't think anybody is doubting that. There are some people who might say, oh, Samsung makes a better phone than Apple. Okay, you're entitled to that opinion. No question, Apple has a lot of loyalty. However, if you look at these companies, there's a lot of history to study. These companies were founded in the 1970s. Microsoft went roughly a decade being flat. And now they've had absolutely massive explosive growth in the stock. That has happened before. In the dot-com bubble, they had absolutely massive explosion in the stock. And Microsoft then made the computers. They made the computers. They made the software. Microsoft made it all. They did it all. They had huge market share in the office, at home, etc. Then they went, after that big run-up, flat for a decade. It's not unreasonable to assume after we were in a TINA environment, a low interest rate environment, and a highly speculative environment, all at the same time, that now with slowing growth rates, that we just might have something similar happen, and that we're not right back to where we were in December 2021. That's my assumption. That is what my assumption is. That's why I'm avoiding these stocks right now at these prices. And I'm going to continue to avoid them. I'm going to wait the storm out. I'm going to wait the situation out. Because I do think that this is what's going to happen. This is what, in my opinion, needs to happen. So I'm being patient. I am short in some ways these stocks. Not aggressively. I'm not using options anymore too much. It's not a thing. I'm going to make that pivot. And I honestly, after my experience with options, I would suggest you do the same. Because you can achieve very good returns managing a portfolio in a very responsible way by avoiding options. No need to get into options, in my opinion. And if you do, very small allocation. They are for hedging and that kind of thing. They are not for full positions. That is my new learning, and I'm sharing that with you to learn and to realize that you can make good returns without options. You can actually make better returns, in my opinion, because they're more sustainable. You have better emotional returns, and I would not use them. So that makes it easier to bet against the stock because you're shorting the stock. You're not buying options against the stock. So that's my take on it. I'm just sharing it with you. So what I said yesterday about mega cap tech, what I've said before, I still believe. And I think the fact that Google, the weakest one, is outperforming, it just kind of seems like people are looking for something that's down to bid it up because they think they're getting a deal, but they're not actually considering the fundamentals. And then something like Microsoft, they're looking at it so high, it's been so strong over the last week or two. Maybe it's time to lock in some gains. And that is my read on what is happening with those stocks. So, in my opinion, that is a sign of a top. That is not fundamental analysis. That is simply judging charts and price. I simply don't think it's going to last. I think this is the end. We're through the positive catalysts. We got the cum shots, excuse my French, but that's what they were on earnings, which were, in my opinion, I care more about the deceleration than the beating expectations because every quarter earnings beat expectations broadly for the market. Every quarter pretty much. That's kind of how Wall Street goes. They want to have a buy rating. They under promise and over deliver on their expectations. And there you have it. So that's my interpretation of it. Next thing I want to talk about is energy. We were down today to start the day, as was the market. And then things reversed, despite the hawkish Fed talk, which we'll get to in a second. Why did energy reverse, oil reverse? Well, the EIA expanded its oil demand forecast. And let's not forget, a big part of the volatility this year, yes, it's been SPR releases. That's why we've been so flat and haven't been able to break out. But it's also been recession fears. And they're very understandable, these recession fears. I have recession fears as well. However, the EIA expanded their oil consumption growth forecast. So they were expecting oil consumption growth over 1 million barrels per day. It's now like 130,000 barrels over that previous number. So demand by the government energy agencies that can track this stuff very closely and very well is going higher, not lower, which is the fear. So I think the fear has been played out, has been acknowledged, and there's still an opportunity right now to take advantage of the dislocation between the fear and the reality. So that's my read on the situation. I like the stocks. They're producing good cash flows. They're paying good dividends. They're cheap. They got everything you want in a stock. So, and they're growing. You want growth? These companies are growing. Many of them are. Some of them are not, but many of them are. You just got to do your homework, find which one's right for you, and buy it and then hold it. Because energy, you just need to know, is going to be very volatile. But through the volatility, assuming the company has a decently strong balance sheet, it's going to continue, in most instances, to do their capital return programs. So you'll get paid to wait. And you know what you got? It's an asset that produces cash flow. And it's very simple how they do that. They have a hole in the ground and they pump money out of the ground. Doesn't get better than that. I'm sorry, it doesn't get better than that. That's what you want. You spend X to get Y per day. Beautiful. That's what it is. That's the game we're in. And these companies, they're the best players in the game in terms of stocks. If you look at everything, if you look at price, you look at earnings ratios, you look at dividends, they have it all. What they don't have is stability. They are volatile, but you make trade-offs. There's people who are concerned about the long-term future. You get your edge by studying that notion, questioning that notion, and coming to the conclusion based on the facts and the projections that oil demand won't peak until 2050. And then you look at all the products that use oil, and you realize gasoline demand is actually a small fraction of total oil consumption. And we're not going to be having a meaningful decline in gas car usage for a long time because cars are lasting longer. Emerging markets are growing quickly. They get our old used cars. Their middle classes are rising. They're going to start getting cars. So you see how this all works out? It's going to be strong for longer than many expect and many fear and many are pricing these stocks at. So you just got to buy them when there's a lot of fear going on, and you just got to hold them. That's it. So that's energy. Finally, let's talk about the Fed. This morning, we had Jefferson with what initially looked like maybe somewhat dovish comments. Inflation's coming down, don't want bank stress, et cetera, et cetera, et cetera. Didn't seem to move the markets. Because the market is really trying to push its pricing of the Fed to a very far extreme. Then we get Williams. Williams says inflation's far too high. The Fed has not paused. We may need to do additional hikes. And a lot of other hawkish things. And tomorrow's CPI. In my opinion, the Fed is leaning in the not pause camp. And depending on how these next couple inflation reports go, they'll be pushed over the edge. Bank stress yesterday, some tightening of stress, but nothing too crazy. It's unclear still, Williams said, how much of an impact it's going to be. So we need to be more data dependent, of course, but I'm not saying another Fed hike is in. I'm not ready to go there yet. But I don't think this is some sort of dovish pause that we're at. So we have to take all these things into account and consider them, see what happens. And that's today's video. Until next time, peace out.